Welcome, everybody. Good morning. Welcome to our market and our political update. So Carson, Myles, and I were just coming back from our Raymond James National Conference. We got to hear panels of economists and other political experts and wanted to have a chance to share with you all of the notes that we took. And we kind of put them together into this presentation to kind of hit the highlights for you. So again, I have Carson and Myles here with us. Guys, hello.
Hey, good morning. David, you said you'd promised to keep the political stuff brief, so I'm going to hold you to that.
Yeah, it's like 2 hours. We should be good. And then
Okay, no more than 2 hours.
they know I can get on a soapbox about this stuff, so I promise to just kind of hit the highlights of that. So on the political notes, I'm going to give you the caveat that it doesn't matter to your personal financial plan. So I know half of you more than likely could care less about all the dramatic election year stuff going on, and then there's maybe half of you that keep up with this stuff. So I'm going to share with you, though, what we learned and what we heard with no political slant or agenda. And I mean that. I'm just sharing the landscape, and a lot of this is going to change. We're also going to be hosting one of the Washington experts that we listened to on the panel on a webinar that we're going to have this fall before the election. So stay tuned for that. So after I go through this part, the political update, we're going to have Carson and Myles are going to go over the economic and more the market type of slides, which obviously are more relevant to your portfolios. And then we'll also have time for any questions that you have. So feel free to just ask a question at the bottom of your screen, and we'll do our best to go through those as we go, or for sure at the end. All righty. So let's talk about the political landscape with this being an election year. So right now, the election, and obviously this could change a lot. It's a tight race. There's probably, according to polls, a slight edge to Trump right now, but there's so many unknowns. There's talks of maybe Kamala or even Michelle Obama, somebody running, and Biden stepping aside. Who knows? Of course, Trump's going through his legal battle right now as well. The U.S. Senate. Republicans are scheduled right now likely to take a majority. There's like a 70% probability right now, according to these experts. But there's still redistricting in the House. And so there's a slight advantage to the Democrats in the House. And so also all the Republicans have had a lot of issues with the Speaker of the House. So what I'm getting at is we're likely going to have a divided government again. And it's what's never happened before, and what they're saying may happen this time is we'll keep a divided government, but there may be a flip in the Senate and a flip in the House to the other party. So that'll be interesting. Also, there's a huge dichotomy this election between the actual numbers and what people think about the economy. So think about this, like 65% people think it's really bad. The economy is really bad, even though unemployment numbers say are really low. The stock market's hitting all-time highs, but people can't afford eggs and things like that. And that's huge. And typically, historically, people vote with their pocketbook. So there's no doubt that inflation is hurting small business community, mortgage rates, causing credit card debts to rise, which is a big issue. And all of those things are going to be key issues for voters in this election. And we're going to discuss those particularly in a few minutes on some slides. And then also key social issues are really awakening people. So many people are going to vote not on these economic issues like inflation, but they're going to vote on some of the social issues. So this is not like other election years. It's going to be very interesting. The key swing states will likely be more so affected by topics like, the abortion issue and sway voters that way. Each election now, it's really how the voter actually weighs the social issues versus the financial impact in their day-to-day lives. So that's the big unknown, is how people are actually going to vote. And what's interesting is when people were polled, a lot of voters were polled, the number one reason they were saying they support Trump is a return to normal. And it's laughable just when you think about Trump's personality and just the whole election cycle, thinking normal. But when the pollsters dug deeper, they responded by saying, what they mean by normal is the border's out of control, inflation's high, and Trump didn't let wars happen. So that's what some of these voters are saying when polled. So, the question becomes, are we going to have a return to chaos in Washington, or is there actually going to be a return to normal to be determined? Many opinions out there. Obviously, this is very emotionally charged when talking to people about their voting preferences. There's also geopolitical risk. So if you look at oil prices, if they move higher due to the Middle East, that really hurts Biden. Or if some other big event happens in that area of the world, that's bad for Biden. You got the legal issues for Trump. If he's convicted at all, even if he's, doesn't go to jail, but he gets a conviction, it's very possible that some of his support drops off. And, 1 or 2% of some of these independent voters dropping off could really kill his potential victory. So that could change as well. And then you have the independent runners. This is the part that's really hard to quantify. This could really impact the small margin for Trump or for Biden. A third party candidate historically can have a huge impact. And you've got one in particular this time that it's unclear if he's going to take votes more so from Trump or from Biden. So we'll have to watch that. And, the Fed isn't supposed to be political, but, they're not stupid and they recognize election cycles, right? And so there's always pressure from both sides, to lower rates and that sort of thing to help the economy. And with the Fed, they've had failures, in the past recently, like telling us that inflation was transitory and that the banking and then you had the banking crisis last year. So they really need to get this right. And so, they're watching really closely as far as when they can lower rates to help people feel a sense of relief with their mortgages and loans and credit card debt and things like that. All right. I think I honored my end of the bargain, Carson and Myles. I'll stop there. I could go on and on about this stuff. And I recognize I probably lost some of you when I said Trump or Biden, but let's move on now to the stuff that's more relevant to you, the economic and market stuff. And again, we'll do more political updates with the specialists here in a few months before the election.
That was good. You honored your end of the bargain. Good job. I think kind of going on what you mentioned, kick off with some of how the market's reacting and what the market has done this year. And this first slide just shows how, like you mentioned, David, there's a lot of disconnect between how, a majority of the people feel the economy and the market's doing as opposed to how the market and the economy is actually doing. I read one statistic the other day that said over half of the people polled think the US is in a recession, when in fact it's truly the exact opposite. We've had 7 straight quarters of GDP growth, and company earnings on a market perspective, they're incredible. Most, as you can see in this slide, most sectors are beating Q1 earnings estimates, and earnings growth is still rising. So that, company profits is ultimately what drives stock market performance and a stock's performance. And that's what's happening. Companies are making money, and it's coming from consumers continuing to spend. So it's almost like, yes, inflation is here, but companies aren't the ones struggling from it. Companies are the ones profiting from it. Right or wrong, raising prices that end up affecting consumers in their pockets. That's what's driving the stock market performance is strong company earnings.
And that's true until it's not anymore, meaning until finally the consumer says, we're not okay spending, $15 for a cheeseburger. We think it's, we're used to spending $8 or $9, and that's when that could shift. But so far, you're right, it hasn't.
That's right.
Yeah, and with that, I mean, this one illustrates that here. It shows, the top companies in the S&P 500 margins still increasing. Nobody likes inflation. Nobody hates it worse than even small businesses, but the big corporations, they've been able to pass along costs to the consumer. And kind of to David's point there, people have been willing to pay $15 for a cheeseburger until they're no longer willing to. When that time is, I think that's anybody's best guess. But to this point in time, consumers have been willing to add on that extra cost.
So then where I think it begs the question of, okay, how healthy is the consumer, or how long can the consumer continue to support rising costs? There's been a record net worth as far as the consumer balance sheet goes. Part of that is, yes, due to housing appreciation and the sheer amount of percentage increase in housing prices over the past 2 or 3 years we've been experiencing. A healthy job market. Job losses are less than average. And we have had, I believe it's 40 straight months of job gains of more than 100,000. So that is the first time in US history we have had 40 straight months of job gains. Now, is that skewed? Yes, because we had so much job loss in 2020 when everybody was laying people off. So there's a little bit of skewing going on there, but it hasn't stopped. This is the first time we're still in uncharted territory. We're still coming off of the pandemic and closing the economy down, and stuff that we're experiencing now is still because of that. It's still lagging. Yes, here we are 4 years later, which is mind blowing to think how fast the time has gone. Some other positive notes: wage gains have increased. They have outpaced inflation. Now, I think there is an argument that they've outpaced inflation. Certain sectors and certain goods, no, it has not outpaced. And there are some signs of rising credit card debt, higher delinquency in auto loans, but the average consumer remains less leveraged relative to other cycles, other market and economic cycles.
And I will point out on that last one, over leverage, you can see where we were 12 months ago and where we're headed. Consumers are becoming more leveraged and credit card balances are getting higher, which is something we're concerned about, but they're not at like historic highs. They're going in the wrong direction for sure.
That's right. And then the last note here, 75% of homeowners have less than a 4% mortgage rate. So with a period of rising interest rates, that affects people who don't have a fixed interest rate. The large majority of people who owned a home during the pandemic and the couple of years following refinanced or bought a home with a sub 4% mortgage rate. And those people are kind of stuck, if you will, in their house because they have such a great interest rate and it would take so much more to go out and buy a new home. But they're not impacted technically with the interest rates being as high as they are. They don't have to go out and get an 8% mortgage rate right now. They're stuck in their home. They have a fixed mortgage rate, and 75% of people have less than a 4% mortgage rate right now. I think I just hit on this.
Yeah, and I would just add too, I mean, maybe you said this, but we've never entered a recession when we had job growth. And so to have the amount of job growth that we're having and continue to have through this cycle, it does feel difficult to us to see where we would enter a recession. Now, the Fed does have a dual mandate: low unemployment and low inflation. Unemployment's low. It's the inflation number that we're really watching that. And I think we're going to touch on this later on, but that could maybe drive rate cuts later on this year. The biggest thing we're watching is the inflation numbers, because unemployment it's in a really, really healthy spot, all things considered.
Yeah.
A couple of market slides we like is just pretty good reminders, this and the next one. But, in any given bull market, historically up until 2020, and really a real bull market, which was in 2022, ever since 2009, the stock market generally was up and to the right without much pullback, you would think. However, every single year, on average, there's a 14% pullback, regardless of if you end up positive 20% for the year on average. And since the lows in 2009, this chart just shows how there's been 30 pullbacks of 5% or more since then. So it just screams how even if the market generally is positive, there's always going to be buying opportunities if you're sitting on the sidelines with cash, and there's always going to be volatility. Volatility is a deviation from the norm that can be to the upside and to the downside. So
that's why oh, sorry, Carson. I was just gonna say, that's why if somebody comes to us like now when the market's at a higher point and they have a big chunk of cash, had a liquidity event, sold a house, rental house business, whatever, we'll say, you know what, let's slowly dollar cost average this money into the market over the next year, and we'll look for 5 to 10% pullbacks along the way to kind of as entry points. And because we usually get those opportunities even in the midst of a market going up, there's opportunities to add new cash.
And returns are all over the place, as you can see. I mean, the randomness to this is crazy. To think that somebody can time it consistently, if ever at all, is, I think, an impossible task. You're going to have up years, down years. We always talk about it's usually up about 75% of the time, down about 25% of the time, which historically has been accurate. But the timing of that is almost impossible to find any sort of rhythm to that.
Yeah.
Broad overview here, this slide and the next slide. It's how a lot of times headlines can drive emotions. News headlines can drive emotions. This slide goes over all historical wars, basically over the past 100 years, and how the stock market's performed relative to that, as well as this slide. It's just saying, here's all some major events that, COVID more recently, to the financial crisis in 2008, to .com crash in 2000s and before that, and how there's always going to be a headline. There will always be a headline. Every single day there's a headline. You could turn on the news today and or tomorrow, every single day, and there's always going to be something negative. However, stock market doesn't care. Stock market cares about earnings, how profitable companies are. Yep. Let's get into inflation.
Yeah. I mean, I don't think anybody hates inflation more. Maybe I said this earlier than small businesses, mortgage, credit cards. David mentioned this is going to be some of the key issues in the election coming up, obviously. But most people view the health of the economy through inflation and how much they're paying for things. And it does still remain a little bit elevated, although it is starting to come down. I think it's going to be difficult to get things to that 2% mark that the Fed is shooting for. But I think time will tell whether or not we actually close in on that, whether they need us to get to that 2% or if they get happy with 3, 2.5, maybe somewhere in there. But this is just illustrating interest rate cuts coming into this year. Depending on who you ask, we were looking at maybe 6 or 7 interest rate cuts. I think with inflation staying stickier, we're maybe going to see some people forecasting 3 still. Some people are forecasting as none. I think there's the opportunity to see a couple still, but they will be later on in the year. It's not going to be 6 in the second half of the year like we were forecasting at the start of the year. It is proven a little bit stickier, but that doesn't mean that's necessarily a bad thing. It would be far worse, in our opinion, if the Fed cut rates and then inflation got out of control and they had to rehike. That would be far worse for the markets than holding rates higher for longer and cutting end of this year or into early next year.
Yep, I agree.
Because you got to think we are in a more normalized rate environment. Having interest rates at 0%, that's not a normal interest rate environment, especially coming out of the financial crisis. Keeping interest rates as low as they did for as long as they did, that's not normal. Average long-term mortgage rate is in the 7s. So having 30-year mortgage rates 7.5%, 8% is more normal. Here's something that we look at on a consistent basis, just to explain what's going on here. This is expectation of where the FFR, the Fed funds rate, is going to be on a given date, and the given dates are Fed meetings. So, for example, right now, upcoming Fed meeting, middle of June, 97% chance that interest rates are still going to be held where they are, meaning the Fed's not going to cut. So you can kind of follow the light blue as the hint of where the market is currently expecting interest rate cuts to fall. So as you can tell, the highest chance for the first interest rate cut is currently in September based on futures of where interest rates are going to be. However, this looks so different every single month that you look at it. 6 months ago, this was saying it was almost a 100% chance of a Fed rate cut in March. And we know that did not happen. And we're still another 3 or 4 months away from the first Fed rate cut. So all of the expectations and the commentary about Fed rate cuts and all the charts that you see of here's where, which we're going to show one here in a second, of where the Fed rate cuts are going to be, you cannot time Fed rate cuts. That is the most difficult thing to do because it's all based on future economic activity. And that's impossible to determine as well.
All of these charts are pretty much like a weather person saying it's partly sunny with a chance of rain every single morning. So, right. Sorry, it's my dad joke.
Which again, this one echoes what I just spoke about. The market implied interest rate path, as well as a forecasted path in the dark blue of what might occur and when. And there's always a reason. Kind of these commentaries on the right, there's always a reason not to cut rates. For example, inflation still above 2%. The Fed cut rates while inflation was still above 2% in 8 of the last 9 cut cycles. And it goes on and on how there's always going to be a reason not to cut rates yet. However, the Fed has their own theory for cutting rates. And, there's we're, from an investor's perspective, we are allocating portfolio positions, a financial plan, not based on where rates are going to be in a month, not based on where rates are going to be 6 months from now. Does it impact the yield you're getting on your money market? Yeah, it does. But our plan goes beyond just the yield that you're getting on a money market.
I think this one's pretty interesting to look at because, you hear about inflation being, at the peak, it was at 8 or 9%, and it's still at 3 point whatever it is today. This just shows cumulatively what it's up since January of 2020. So you see up 21.1. I think you could argue it feels like more than that. And when you add in the cost of fuel and food, which is left out of this number, it's definitely more than that. But
which blows my mind. It's left out of
yeah,
this. I think most people would say like their top pocketbooks, when you look at like the price of ground beef and the price of eggs and gas, those numbers are more like 40, 50, 60, 70% cumulative. But so that's what I hear from people most of the time.
There's a chart where it talks about the price of the Big Mac relative to inflation, and the Big Mac pricing at McDonald's has far surpassed increases relative to the CPI. I think the Big Mac's up like 100% in price since 2020.
And I think it's gotten about half as big also. So it's cost twice as much and it's half the size.
Shrinkflation. Yes,
Shrinkflation, that's
the
right.
Big Mac is now our benchmark. It's like our S&P 500 benchmark for portfolios. There we go.
Here's a little bit more political stuff for you, David.
Oh yeah.
As David highlighted and mentioned earlier, we like to echo everything that he said, how your investment decisions should not be dictated to political beliefs, because ultimately, regardless of presidential political party, there is next to no difference in overall performance dating back as far as we can date back market performance. Annual compounded return, both are right at about 8% over the long term. Same with this next chart. Whether it's a split Congress, whoever's in president, still extremely similar return probability. Lastly, pretty interesting, growth of 10 grand since 1949, fully invested in the overall stock market. That turns into, what is that, 3.5 million. And then if you only kept your money invested when your political party was in favor, Democratic or Republican, your returns are largely muted, whether that's Republican or Democratic, not near the performance, which just goes to show, which I don't think anybody would necessarily only be invested when their political party is sitting in the presidential seat. However, it just screams the fact to stay invested regardless of those things.
Yeah. Ooh.
Talk some national debt. David, how do you feel about the national debt?
I mean, 34 trillion and counting. I remember in 2000 and just the last 10 years ago when I was speaking at investment groups, and they were saying, and there were books written about if the federal debt got to 20 trillion, then the dollar was done and was no longer the kind of the stable world currency. And, obviously we flew past 20 and now we're headed towards 40. And there's an argument that says it doesn't really matter because the US historically has been so good at kicking the can down the road and not making the tough decisions, or we're still the prettiest house on an ugly block compared to the rest of the world economically, however you want to look at it. It's not a good thing, obviously, but it doesn't mean that, we're going to have some great depression because of that number, because as long as companies are growing and GDP, there's GDP growth and that sort of thing, it's all about the ratios. So it is concerning. What's more concerning to me is, we have a deficit of like $1.6 trillion a year, and likely there's no changes anytime soon. And that's a huge problem. I think the last time we had a budget surplus was under Clinton. And during that time, though, we also had 4.5% GDP growth. And right now you have credit card debt that's piling up. The government's getting larger and kind of crowding out private business. And then you have a 5.5% federal funds rate. So it just makes it hard for this economy to do more for more citizens. That's what's kind of happening right now. And also I look at this and I know that 20 cents of every dollar right now is going, from tax revenue is going to pay interest on the debt. And that's a huge issue, especially with the interest rates. Myles mentioned earlier about, it's usually you don't go into a recession when you have job growth and that sort of thing. Speaking of recessions, usually national debt increases by about 15% before you go into a recession. So if we're at 34 trillion now, this would imply us getting up to that $40 trillion number before going into a recession. So yes, we need and I'll stop here in a second. I think we need a major course correction. There needs to be a focus on mandatory spending. I mean, that's 2/3 of all the spending that the government does. You look at like Social Security. We've done webinars on this. They probably, somebody needs to raise the retirement age for, somebody being born into this country now, maybe somebody in their 20s, 30s, obviously not people using Social Security or maybe within 10 or 20 years from that. But there's some small changes that could be made now that people are living to be 90 instead of 65 back when Social Security was implemented. We can make those changes now and really fix the equation, fix the algorithm, and, kind of free it up for the next 30, 40 years. It's just been really tough. Like, it's been almost like political suicide for any candidate to talk about touching Social Security. So,
you don't spend like the government is spending in an economic boom per se. So that's the issue. The spending which occurred at these levels back, but during war times, that has that's makes a little bit more common sense as opposed to the spending and the deficit spending that they're doing now while the economy and the GDP is growing like it is. So that's what's so hard to wrap our mind around, especially when there's, like you said, these programs that the government has, Medicare and Social Security, that need some substantial changes if they're going to continue to last for decades and decades to come. And, despite the fact, I think for like my generation, it's ultimately going to be, no, my full retirement age isn't 67. It's going to be, I don't know, 75.
right.
It's either that or tax higher or lower benefits.
Well, and that makes sense for like your generation and in the generation below you. I mean, otherwise, Social Security, Medicare is supposed to default like in the next 5 to 10 years. I mean, there's the easy solution. It's to just change the age more than likely instead of just raise taxes. But that's the kind of battle there. And then also something else that, like the government spending, something else that's not sustainable. You look at things like drug pricing. You have like, for example, what's that drug? I think it's Ozempic. It costs like $1,000 a month in the US, but it's like $200 a month in Japan, I heard recently, and it's in Europe, it's $100 a month. So there's an example of a drug that's used a lot here that's 10 times the price here versus in other countries. So there's just a lot of systemic changes that need to happen with spending and price structure and, entitlement programs and that sort of thing. It's just tough for political candidates to tackle those issues. Shouldn't be, but it is, just because of fear of getting voted and the election cycles and all that.
Couple of switching gears a little bit to real estate here. That's kind of the last little section that we were going to cover, is just some metrics on real estate and where the real estate market is across the US. I mentioned this earlier, but the average effective mortgage rate is still at 4% across the US. Here's state by state where the average mortgage rate is sitting at. California with one of the lowest mortgage rates at 3.7, even though 2 or 3 weeks ago, the average 30-year mortgage rate's at 7.5%. It just goes to show how many people have refinanced and how many properties out there have a low interest rate. And I believe close to 40% of closings right now are with cash. So that also means people who are buying real estate with cash, again, are not affected by the elevated interest rates.
And this one's just showing the increasing costs for housing across the country. I mean, it's up everywhere, but you see those states where people really move to: Tennessee, Florida, Texas, large increases in housing. So when rates were 3 and 4%, some of those houses were a lot more affordable for people that were taking out a mortgage, and $1 million on a 3% rate is much easier to pay than $1 million on a 7.5, 7-8% rate.
Or according to this, that $1 million price is now like, $1.5 million, and now it's a 7% because prices have gone up, like, for example, 61% here in Tennessee. So,
yeah. And it really is, there's lower demand now. The issue is a supply problem. So still, even comparing inventory levels compared to 5 years ago, pre-COVID, Tennessee still has 13% lower inventory of housing compared to other states. Look at the Northeast. They have 50% on average lower inventory of housing compared to 5 years ago. So it's really a supply problem. You see places like Texas and Florida who aren't as affected as bad because there's so much more demand there. So it's matching the supply with also people selling. But some of these places, especially the Northeast, are just struggling for supply. And even if there's a less demand, the demand is still outpacing supply.
Yeah. So that's why prices are staying up.
As I mentioned earlier, the average mortgage rate right now is close to $2,900 for the median asking price on a home at 7.25% on a mortgage rate. You go back to 2021, as you can tell, it was below $1,500 before there. And that was
Almost double. So that same house, when you look at the price going up and the rates going up, it's now $1,500 payments, now $3,000.
when you factor in average household income, rates, and housing prices. There's a housing affordability index, which essentially has stated that housing affordability has never been worse in the United States. You've essentially not allowed wages to keep up, and you've crammed in housing appreciation, a 10 to 15 year housing appreciation into 2 or 3 years. And it's just, created such an issue for people to buy a home, especially for first time home buyers.
Geez, that's super positive, Carson.
I'm just reading some stats here.
I think the next slide though shows, increases. We are still seeing increases in housing, which is, crazy to see with rates at record highs in the last decade. And so people are still paying the higher prices. There's a thought process of buy now, refinance later. That works until it doesn't, or it's a great theory and maybe that doesn't work out. So I think all that, like, to encapsulate the last couple slides, is just when you're buying a property, buy it assuming that rates are what they're going to be and that you may not have the opportunity to refinance.
That's a good point. Good point. Last couple of things to go over. Stock market concentration. There's been a lot of discussion of Magnificent Seven or the top 10 companies and how much they've essentially contributed to the stock market performance really since COVID, really since 2020. The top 10 account for 34-ish% of the S&P 500 market cap. And the S&P 500 is based on market cap. It's not equal weighted to all 500 companies that are in the S&P 500. So those top 10 companies are going to contribute a lot to the overall performance. And even historically has contributed I think in 2021 to over half of the stock market performance in the S&P 500 was related to the Magnificent Seven, or the top 5 or 6 companies. And so we've seen this get high. There is a reversion to the mean. There's always a reversion to the mean in the stock market. So we do expect that at some point the rest of the stock market to catch up, and that's already started to happen in certain pockets.
Yeah, you look at those big companies, but then at the end of the day, when you're looking at small businesses, they really truly are the backbone of the country. The majority of employment is made up through small businesses. With companies under $100 million in revenue, it's 96% of all business here in the United States, which is crazy. You think about the big S&P 500 type companies, but small businesses are where all the unemployment's at. It's only 18% of employment is made up through those top 500 companies.
That's kind of hard to think about, because you think about like companies like Walmart that are some of the biggest employers in the world with like 1 million employees, but every company in the S&P 500 only accounts for 18% of the total U.S. employment. That's interesting to think about.
Yeah, so much of it is government jobs.
Government
and private, and then private. Yeah, private, but that's private.
Really, the last thing here, last slide we wanted to touch on before we start taking some questions, is international / where the U.S. stands. The U.S. has continued to earn more and more and more of a share of the global GDP, especially as these top 5 companies in the world, NVIDIA, Apple, Amazon, Microsoft, continue to gain global revenue and also just continue to grow in overall size. So the U.S. has roughly 27% of the total global gross domestic product is right here in the United States, which that's why historically how we've allocated portfolios has always been with an extreme weighting towards the U.S. Obviously, it's important because there's 20% of the global GDP is in the EU and UK, so it's still important to own those areas. But again, we emphasize why we have an overweighting to the U.S. And it's justified with how much the U.S. contributes to the global GDP.
Yeah, and inflation, I don't think it's illustrated here, but inflation high here, but in other parts of the world, it's been out of control much more, to where even at these current levels, we're far better off in the U.S. at 3% and 4%, where other companies have been hanging out at double digits.
Questions.
Let's see.
All right. I don't see any questions so far at the bottom. We'll give you a minute or so if you want to type one in. But this may mean that we covered everything perfectly, guys.
Got one for you, David. There's been a lot of talks recently about gold. So how do you feel? How should clients or anyone who's interested in investing in gold handle the all-time highs that gold is reaching? And should it even be a part of a portfolio?
Yeah, I've had this question for 20 years, and the answer is kind of still the same with gold. It's historically been more of a fear-based investment and more of a trading type of its state. You know, it'll hit all-time highs and it'll fall back to a 10 or 20-year low. And you look at it over like 30 or 40 years, the compounded rate of return is very, very low. I mean, last time I looked, it was like even below that of CDs and money market. And so I would say owning gold does not need to be a part of a standard asset allocation. It's more of if it's just a, you know, if you want to own somebody, sometimes people like to own just like, you know, $50,000 of actually a part, you know, a bar of gold or some gold coins or something more. It's just like a collector's thing and a little bit of a, you know, end of the world type scenario. I don't think it's a terrible thing to do there. I don't think it's a necessary part of an investment portfolio. As a hedge, I think there are better ways to hedge a portfolio than with gold. But a lot of, you know, probably 25% of our clients will tell us they have, you know, some money in a gold index fund or they've got some in their safe, that sort of thing. But it's not a big part of the portfolio. And now with things like crypto and Bitcoin and things, people use that for the same logic. It's kind of like the modern day gold. It's just like a way to kind of hedge the dollar and kind of all the other unknowns out there. And again, I'm not saying you should do that either. That's a whole other conversation.
That's good. A couple questions that came in. One was, how are low birth rates going to affect real estate 10 to 20 years from now with supply and demand? And I think that's a really good long-term question because there's kind of a population crisis across the globe with essentially countries not have enough babies to sustain population. So essentially there's going to be population decline because people aren't having enough kids. And it's become a serious issue in China and Asian countries, but it's actually happening in the US. We just hit, I think, the lowest recorded birth rate here in the US since they've started keeping track of that metric. And I think, you know, if you think about all the real estate that's being produced, the baby boomer generation and being a large majority of homeowners, and when that shift happens, if there's not enough demand, absolutely. I think even, you know, you mentioned in your question 10 to 20 years from now, but really 20 to 40 years from now, what is the real estate market going to look like? And it's really, that's a good question. Obviously, it's impossible to sit here and predict how the supply and demand is going to work out or if population increases continue to occur. But there's also immigration that happens. People continue to move to the US, so that can help sustain it. So something to watch, pay attention to. But.
Yeah, great question. Don't know the answer to that, but I think it's a good conversation point and something that we're going to start hearing a lot more of as that stat keeps going in that decreasing direction for sure.
And the last question we have here, thoughts on a diversified portfolio versus pure index investing and how we're going to think about future performance there.
Yeah, I would answer that by just saying, you know, I've heard wealth managers, I've been in tons of forums where, you know, some wealth managers, they use all diversified portfolio and maybe using like active mutual funds or active managers versus the other, you know, doing pure index investing, which is, you know, just buying the indexes, lower cost, et cetera. And then some only do the indexing. Well, what we found in our investment committee, first, I'll say we do both. I think they both hold a place in a portfolio. You want to have a foundation of a diversified investment portfolio, whether you use index funds or active managers. But some years active managers outperform and some years index, you know, the indexes beat the managers. And so we like to use both for different reasons. We do things like we try to make sure any active managers that we have are, you know, over time, you know, more often than not beating their indexes net of any fees. And if they're not, we fire them and we pull in an index fund for super cheap to fill that part of the diversification of the portfolio. And you want your team like us to be watching that and to say, you know, there's some parts of the market it makes sense to have an active manager where they can add value. And other times it's like, you know, 90% of the managers can't beat the market in this part of the, you know, can't beat this index. So we use that. Also, we look at things like qualified accounts, IRAs, and things like that, where we can use some of the active managers because we don't have to worry about how often they're trading and tax efficiency. We're okay to let a manager maybe go after some better returns in a tax efficient way. But in taxable accounts or non-IRA, non-401k accounts, we may use index funds because A, we want some index funds, B, they're cheap, and C, they're more tax efficient typically than regular active managers. So long-winded answer to say, both are good. Your advisor needs to know how to use both of them, to use them in the right buckets in your portfolio, and then to have a lens and a process to evaluate, are they doing what they're supposed to be doing, and be willing to pivot back and forth between the two, which is what we do.
And I would add too, I think it depends on which parts of the market you're talking about. If you're talking about large cap, I mean, last year when, over half of the return of the S&P 500 came from 7 stocks, it's going to be very hard for any manager to beat an index in that scenario. But if you're talking about international or maybe smaller mid cap, where it takes a little bit more research and more research needs to be done on those companies to find the profitable ones or the ones that are actually adding value to their customers, there's where an active manager can deliver value in areas like that are a little more specialized or just require more research to own the right companies.
Yeah,
That's right.
great questions. Those are the only questions I see. I'm sure there are more. If you have them, feel free to email us or reach out. You can reach us anytime. We'll be back doing these. We do these every quarter or so. We'll have a political expert coming on. We have lots of stuff always to come. So thank you so much for your time today. Thanks for listening, and let us know if we can help.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor's situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.